Hello, I'm here today with Harald, Lead Investment Manager for the International Biotechnology Trust at SV Life Sciences Managers. Carl, welcome.
Thank you.
Could you start by just telling me a little bit about what the International Biotechnology Trust is?
The International Biotechnology Trust is an investment trust listed on the London Stock Exchange since 1994. The SV Life Science Managers have been managing this fund since approximately the year 2000 in different shapes, and I'm part of a team of 3 persons with Kate Bingham, Elsa Craig and myself managing this fund. We invest in quoted and unquoted companies, and I think this is what distinguishes us from other investment trusts. It gives an investor the breadth of investment across both the unquoted and quoted side. We do mostly biotech investments in the United States, but also medicinal technology and life science tools investments.
What do you think are the key attractions for a potential investor?
I think the main attraction is the appreciation in value that you can get in this sector. And that's based on growth, earnings growth, that's based on sales growth, and that is of course then based on products that have come to the market recently and will come in the future. And what I'm talking about are pharmaceutical drugs mainly. New therapies for serious diseases like cancer, multiple sclerosis or hepatitis C infections. The innovation mostly coming from universities across the world is being transformed into new products like new drugs, and that will then command the value creation. I think this value creation will go on for quite a long time because we are only in the early starts of understanding of what the human being is, what the disease processes are, and we will see a lot of new drugs coming into the future. That will then fuel top-line growth of companies, earnings growth, and hopefully also return for investors.
And what's your approach to managing the fund?
Our approach is to look for good new products that can deliver good sales, and mostly these products will be in areas with high medical need. What I mean with high medical need is that there are some serious disease behind that you want to treat. So it's not like a headache or something more simple where we already have drugs at low pricing. So in order to command good pricing in this environment of discussion of price pressure, it's important to have drugs that where you can see a good positive outcome of the treatment that is then you would like to pay for, like you get cured for hepatitis C. I think that is a good proposition. And similar type of benefits that are quite strong.
Now, back in 2000, we saw a spike in the biotech stock, followed by a sharp crash. What's different now?
I think the major difference between the 2000 era and now is that in those days, most of these valuations were based on dreams. Platform companies without products that I've been talking about. Nowadays, the industry has much more real products in development and sales. So, I mean, for example, this trust is invested in companies that have earnings. 60% have earnings this year, and if we combine it with the ones that have earnings also in the next year, it's 70% of the trust that is invested in companies with earnings. And only 30% of companies do not have earnings, are kind of early development stage companies. In the year 2000, it was much different. It was mostly companies without earnings, maybe even without products, only kind of platforms in an early stage of development. So it's much more fundamental now, and from a valuation point of view, you can look at earnings growth and look at the traditional valuation metrics for the larger biotechnology companies.
Carl, thank you very much for joining us.
Thank you.